Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings to uncover the real stories behind the numbers. And today we have a fascinating little announcement from SEIT Acquisition Corp. Get ready for a story about shares, rights, and a company splitting things up to make them trade separately. This might sound a bit technical, but we promise to break it down into plain English so you know exactly what is going on. And before we dive in, if you find value in understanding these corporate moves, make sure you hit that subscribe button. Also, join our growing Discord community, link down below, where we discuss these filings and more. So, what is SE Acquisition Corp telling us today? Well, it all revolves around a decision made on the 16th of January 2026. The company is announcing something significant regarding its units, which were sold during its initial public offering. Remember, a unit in these situations is like a package deal. It usually contains more than one type of security. In this case, each unit was a combination of one Class A ordinary share and one share right. Now, these units have been trading as a whole, but the company is saying that starting the 20th of January 2026, holders of these units will have an option. They can choose to break these units apart and trade the Class A ordinary shares and the share rights separately. Think of it like buying a combo meal and then deciding you want to buy the burger and fries as individual items. Currently, these whole units are trading on the Nasdaq under the symbol CGCIU. But when they start trading separately, the Class A ordinary shares will get their own ticker symbol, South Carolina II, and the share rights will get CIR. The company is explaining that. If you want to split your units, you'll have to contact their transfer agent, Continental Stock Transfer and Trust Company. They are the folks who manage these administrative actions for the company. This move is generally done by special purpose acquisition companies or SPACs. SPACs are often created as shell companies to raise money through an initial public offering with the sole purpose of acquiring an existing private company. After the acquisition, the SPAC effectively becomes that private company, now publicly traded. The separation of shares and rights allows investors to trade these components independently. This can sometimes lead to more efficient pricing as the market can value the underlying share and any associated rights separately. Now, let's talk about what these rights actually mean. Each share right entitles the holder to receive a fraction, specifically 1/5 of a Class A ordinary share. This is contingent upon the company successfully completing its initial business combination. Essentially, the rights are a sort of sweetener or a future potential benefit tied to the success of the company finding and merging with another business. By allowing them to trade separately, investors who are more speculative about the future business combination might buy the rights, while those focused on the current share value might buy the shares. The Class A ordinary shares are the primary equity of the company. A par value of $0.0001 per S-share is extremely low, which is very common for ordinary shares in these types of corporate structures. It's more of a nominal value than an indicator of worth. The real value comes from the company's assets, earnings, and future prospects. This announcement itself is dated the 16th of January 2026. This means the decision was made and communicated by the company on this date, and the separate trading was set to begin just a few days later on the 20th of January. This timing suggests a clear strategic move as part of their operational plan. The document also notes that SE Acquisition Corp is an emerging growth company. This classification is important because it means the company can take advantage of certain regulatory flexibilities provided by the Securities and Exchange Commission, or CFE for example. They might have an extended transition period for complying with new or revised financial accounting standards. This can give smaller, newer companies more time to adapt to complex accounting rules, which can be a significant burden. This entire announcement is essentially disseminated through a press release, which is standard practice for such corporate events. The filing we are looking at is a Form 8, which is used to report significant events that shareholders should know about. The fact that this is the main event reported in this filing highlights its importance to the company and its investors. Now, let's look at the bigger picture. This move to separate units into individual components is a common tactic for SPACs. It aims to provide more flexibility and potentially unlock value for shareholders by allowing different investor profiles to participate. For instance, an investor who is very bullish on the company's eventual business combination and its potential acquisition target might be willing to pay a premium for the rights projecting future value. Conversely, an investor who is more cautious might prefer to own the Class A ordinary shares directly, focusing on the current stability and potential immediate gains from the stock itself. This separation also means that the market will now provide distinct valuations for the shares and the rights. We could see the share price fluctuate based on market sentiment towards the stock itself, while the rights price will more directly reflect the perceived likelihood and success of the upcoming business combination. If the company announces a promising acquisition target, the rights might see a significant surge in value. On the other hand, if the deal looks shaky, the rights could depreciate rapidly. It is important to remember that these rights, as described, are a form of a call option, giving the holder the right but not the obligation to acquire a portion of a share under specific future conditions. Their value is highly speculative and directly tied to the company's ability to execute its core mission of finding and merging with a profitable business. While we don't have detailed financial tables in this particular filing, the structure of the event the separation of units points to the typical financial engineering involved in SPACs. The initial IPO raised capital, and now the company is creating more liquidity and trading options for its securities as it moves towards its target acquisition. Looking at it from a broad perspective, this is less about deep financial performance analysis and more about understanding the mechanics of how publicly traded entities, especially SPACs, manage their securities. The success of CC Acquisition Corp will ultimately depend on its ability to identify and successfully merge with a company that has strong fundamentals and growth potential. The current move is a step towards facilitating that process and offering investors more granular ways to participate in that journey. This filing doesn't reveal ongoing financial health in terms of revenue or profits because the core of this announcement is structural, not performance-based. It's about how the pieces of the company are being made available to the market. Think of it like a chef preparing ingredients for a complex dish. The focus right now isn't on the taste of the finished meal, but on ensuring each ingredient is presented in the best way possible for the cooking process. So, what is our take? This is a standard step for a SPAC. It's about creating trading flexibility, the key risk here, and it is a big one for any SPAC, is the company's ability to achieve its acquisition goal. If they fail to find a suitable merger target within the stipulated timeframe, the investment can be significantly impacted and the value of both the shares and the rights could decline. On the other hand, if they announce a strong acquisition, this separation could prove beneficial, allowing investors to tailor their exposure to the combined entity. The company's direction right now is defined by its search for a merger. The main opportunity lies in finding a target company that is undervalued or has significant growth prospects. The biggest risk remains the inherent uncertainty of the acquisition process. That is our breakdown of this Accession Acquisition Corp filing. What are your thoughts on this unit separation strategy? Do you think it will benefit the company and its shareholders? Let us know in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more corporate deep dives. And don't forget to join our Discord community for real-time discussions. Thanks for watching, and we'll see you in the next one.